Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Slower growth. Nvidia delivers a lackluster sales forecast after 2 years of booming AI spend, sending shares lower in after-hours trading, weighing on markets. Bloomberg learns Mexico plans to raise tariffs on China as part of its 2026 budget proposal next month. That's after months of pressure from President Trump. Plus, oil is falling this morning, despite Peter Navarro stepping up the pressure on India to stop buying Russian crude. Traders focusing on the risk of a supply glut. Well, it's just gone 8 a.m. across the Emirates. I'm Aathira Prasad in Dubai. The main event yesterday, as we were previewing, was always going to be those Nvidia earnings sets. So we're going to delve a lot deeper into what we got out of those earnings. But essentially what you need to know is the after-hours performance was one of disappointment. The stock was trading as low as 3% in after-hours, despite the fact that they beat on top and bottom line. I guess the bar was so high for a strong beat that we are seeing somewhat of a position trimming this morning. We'll talk more about that in a while, but you can see futures dipping a little bit, S&P down 7 basis points, and Nasdaq also down about 0.2%. Clearly, Nvidia there having somewhat of an impact on the way Nasdaq is trading. The USD also slipping. This would be its third day in a row, a day of declines for the greenback. And then we've got Brent also down about 0.8%. And I guess investors looking past the pressure that the U.S. is applying on India to cease buying Russian oil, they remain defiant and really focusing on the demand and growth outlook for the rest of this year. Okay, let's also check in on how markets in Asia are faring. Yvonne Mann is in Hong Kong. Yvonne, run us through these markets.
Yeah, Jemima, despite what you mentioned, right, the after-hours trade in Nvidia, we thought it was going to be kind of a bit of a sell-off here in Asia. We've actually been taking it in stride. When you take a look at some of these tech-heavy benchmarks like the Kospi in Korea, like Taiwan, are actually doing okay. Maybe because there weren't any huge negative surprises, but certainly the fact that they took out China and the H20 sales in its outlook for the third quarter did in some ways boost some of these local chip makers in China. So maybe that gives them a bit of a window to continue on this sort of self-reliance theme. This whole China for China, buying China, is something that we've been really tracking on the China show. So when you take a look at some of these names like Taiwan Semi, that's the one certainly that is seeing a big drag here. We're down about 1% on TSMC here on the back of those Nvidia earnings. Samsung is slightly down as well. But look at the ones in China, and these are the onshore listed ones. SMIC last trade and leading up to that lunch break was 13% higher. Cambricon Technologies, this is kind of seen as maybe the next sort of challenger to Nvidia in China. Homegrown and the like here. This briefly yesterday became one of the most priciest stocks onshore and briefly surpassing the likes of Queiqiao Maotai when it comes to the stock price. So certainly there's a lot of talk about these homegrown sort of champions that are emerging from this U.S.-China tech rivalry there. Another one to watch is, of course, Meituan. That's why we're seeing the HSI down here this morning. You take a look at that, 10% drop on the stock. The sell-side analysts are slashing those price targets. This is after the company warned of the major losses ahead, given this fierce competition in the food delivery space against the likes of Alibaba and JD.com, and the likes of Citi saying now, investors are not really going to have that much patience to wait for profitability to really kind of improve for the company.
Yeah, so a tale of two halves. You've got the retail Meituan dragging down the index, but then the chip makers actually showing a lot of green. Yvonne, thanks for the recap. Some numbers coming through from Europe this morning. European car sales have risen 5.9% to 1.09 million in July. What's crucial about these numbers is that they have shown the biggest gain in 15 months for the European car industry. So that is quite notable. I would also just point out that plug-in hybrids have made the biggest jump in July of 52%. So those continue to do quite well. As for sales of fully electric vehicles, those rose by more than a third. That is also the best result in January. So quite interesting to see that despite the gloom about the auto industry in Europe right now, you are seeing a quite healthy sales picture, the highest rise in 15 months. And then also to note, because this has been relevant for Tesla, Tesla sales have slumped 40% in Europe. That is 40, which is quite significant. Tesla only has a market share of 0.8% right now in Europe. So very interesting numbers coming out. All right, let's go back to the main story of the day. Nvidia has issued a tepid revenue forecast for the current period. fueling concerns that AI spending is slowing. The firm expects sales of about $54 billion in the third quarter, excluding data center revenue from China and trailing more optimistic estimates.
If geopolitical issues reside, we should ship $2 to $5 billion in H20 revenue in Q3. And if we had more orders, we can build more. We continue to advocate for the U.S. government to approve Blackwell for China. Our products are designed and sold for beneficial commercial use.
Let's get more from our Asia Tech correspondent, Annabelle Jewelers in Hong Kong. Annabelle, maybe dissect this in further detail for us, because on first blush, the top line, the bottom line were actually beats. What is it about these numbers that have sent these stocks down, the stock down in after-hours trading?
Yeah, I think there's sort of two main factors. I mean, on the one hand, it's just those lofty projections, and that's what Nvidia couldn't meet. I mean, for the third quarter, for instance, fiscal third quarter, as you said, I mean, it was pretty much in line with what estimates had been, which was for $54 billion of sales. But at the high end of the scale, people were saying it could have been up to $60 billion. And so that's where that disappointment is allowed to creep in. I mean, yes, options have been indicating we'd see around a 6% jump or slide, but we've only seen around 3% down in late trade. So that is actually a bit better than what could have happened in the market, and maybe why you're seeing a bit more of that trading looking a little bit more subdued. I mean, as Yvonne was pointing out, it's not really coming across into a lot of the Asian chip names today, for instance. What else really stood out, though, is really the China data and that big China question. It was one of the key unknowns going into the numbers. How would they be faring with H20 sales? What would they be looking to do in terms of maybe having a specific Blackwell system or architecture as well designed for the mainland market? But just given the lack of clarity around what exactly is going on, especially from the China demand side, Nvidia said that they actually weren't able to bake in any China sales at all into their upcoming forecast. So again, they're probably two of the main factors that really have come out of the numbers today.
Yeah. But let me ask you also about something else that has come up beyond the geopolitics of their ability to sell into China and what's going to happen with the future of the chips there. Trump floated the possibility of charging 15%, a levy almost of the sales that Nvidia actually does make. What is the latest language around that?
Yeah, so this actually relates back to the H20, which is the chip that was specifically designed for the mainland Chinese market. And so sales of that were halted by the Trump administration. Jensen Huang, of course, lobbied very extensively. His argument, and what you're seeing exactly happening right now, is that the more you restrict China, the more you propel it forward in that push for self-reliancy. Part of the agreement to restart those sales was the Trump administration essentially said, we want 15% commission on any sales that you're making, plus AMD, on chips to the mainland market. So what was interesting, because actually following the numbers, we had an interview with Colette Kress. She is the CFO of Nvidia, and she really pushed back on the 15% fee. Essentially, she said that the government actually hasn't so far indicated how they want to put those regulations in place. Failing having any sort of clarity on it, or if the plan isn't codified, Nvidia is actually saying that they could actually progress or pose rather legal challenges to the business, and that they would be proceeding with sales to China if and rather not pay any commission. So that was sort of the big takeaway from that interview with Colette Kress, not looking to pay any commission on sales of chips to China. The question is, I mean, does China really want those chips right now? And so far the signals are, no, they don't. They want to continue to push those homegrown champions, like Cambricon, for instance, a fellow chip designer in China.
Yeah. And it was pretty interesting that they said that they actually didn't ship any chips to China in the last quarter, which is notable, but also means that there's a potential upside in the coming quarters if they do start shipping. Annabelle Jewelers, thank you for helping us make sense of it all. Well, tech shares are lower in Asia, and U.S. futures point lower after Nvidia's earnings report. Joining us to discuss more is Sumant Wahi, portfolio manager at Man Group. Good to have you with us, Sumant. So big day for anyone invested in the tech space. Let me just start off by asking you whether you think there are some signals coming through from this earnings report suggesting that this growth momentum in terms of the collective AI spend is no longer sustainable.
Thanks, Jemana. Thanks for having me again. In my mind, I think this is, as I think Annabelle and Yvonne said perfectly, it's a bit of an expectations miss, and there was China missing in it. So I'm not reading too much of a slowdown in demand from this per se. I think, in fact, in these high numbers, a sustainable run rate is more than what we should expect at this point. So I'm actually fairly comfortable with this and what it means for the overall AI infrastructure. But at the same time, I think investors in general are trying to slowly move from just investing in the enablers of the technology to more into the builders and innovators sitting on top of this technology, which is a fair ask and a fair way the technology investing will move in this space, so to speak.
It's interesting that the CEO, Jensen Huang, said that he expects $3 to $4 trillion of AI infrastructure spend by the end of the decade. $3 to $4 trillion. We know that this year alone, big tech are probably going to spend around $600 billion. These are eye-watering numbers. At what point do you have to be asking serious questions about monetization?
Look, I think we spoke 10 months ago, and we were talking about the same concepts about ROI on AI. And although a lot has changed in that period of time, that is still the key debate as we see it today. And when I specifically look into certain subsectors like the internet, we are seeing some real change at the back of applying AI in internet companies, not just the Metas of the world, but also into smaller companies further down the value chain, so to speak. And as such, I think that is what will sustain this level of demand. I see the AI infrastructure as sort of the new electricity of our times, and as a result, I think that 3 to 4 trillion makes sense as long as you can prove the return on that investment.
But a bit of caution is due. I also want to reference this MIT paper. Loads of people in the industry have been talking about it, suggesting that 95% of generative AI pilots don't work out. Only 5% do. So that tells you that you have to be really discerning about the types of projects and the types of endeavors that you are engaging in and investing in.
Absolutely. In fact, I was reading that over the weekend, and it's actually very specific. It talks about the fact that how nuanced that investment into AI needs to be for these enterprises. Companies which have actually looked for not the headline sort of changes in their processes, but actually in back offices, and actually have gone to see some real discernible change at the back of it. So with every technology, when it is driven by the management, by the board, without actually any underlying processes changed, it is always doesn't live up to its expectations. But when there's a grassroots change, we do see that benefit. So I think with AI, of course, consumers are the first to adopt, and we are seeing some real change over there. Enterprises, there will be some digestion. There is a slower pace. And I think a lot of folks have said this before. Technology always is slow in the near term, but surprises on the positive on a longer period of time. And I think AI is the same. I think enterprise adoption is there, but it's a bit slower than what people expect. But I think there is real change, especially in software.
Let me ask you about the China homegrown market. Interesting what Yvonne was saying when she was sort of recapping the markets a short while ago, suggesting that some of the local chip makers have really started to charge ahead and perhaps did sense a window of opportunity because Nvidia was cut off from the Chinese market. Nvidia themselves saying that they weren't able to sell any of their H20 chips. How do you see this dynamic playing out in the coming quarters?
Look, I'm a very big bull of generally the focus on Chinese self-reliance, so to speak. And we are seeing that benefit happening at this point of time. I mean, Chinese tech sector has shown improvement, not just in algorithms, in some chips and then semiconductor manufacturing. Ultimately, it is a combination of geopolitics, both from the Chinese government as the U.S. government, and at the same time, sort of processing performance per dollar, so to speak. And Nvidia still, as all the benchmarks show you, is leading in that perspective. So the companies, the customers, effectively the Chinese customers, as well as the government, needs to decide whether they're going for the best performance per dollar or whether it's the self-reliance, which is the focus. I think both have their due space today. And while in the near term, because of the geopolitics, Nvidia is not being able to ship, if you take a step back, I don't think I would have been able to forecast 3 years ago that the Chinese chips or Chinese algorithms will be as competitive as they are today compared to the Americans.
Yeah. That's a good place to leave it. Sumant, always good to chat to you and on such an important day for chip makers and AI. Sumant Wahi, Portfolio Manager at Man Group. Well, up next, Mexico and the European Union take action to meet President Trump's demands. The latest on global trade just ahead. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. China is finding one of its biggest growth markets far from home. Africa is quickly emerging as a key hotspot, with exports to the continent on pace to top $200 billion for the first time. For more, Bloomberg's Aathira Prasad joins us now from Kigali, Rwanda. Aathira, we've been talking a lot about the impact that tariffs are having on the direction of global trade. And of course, China very much in focus. Clearly, they're looking for new markets. One of those new markets appears to be Africa.
Absolutely, Jumana. And you can see that as that trade war unfolds between China and the U.S., demand for Chinese goods in the American market is declining negative 30%. But on the other hand, there's an influx in Africa on track to hit 60%. And this just speaks to China's broader effort to seek alternative markets to diversify their export market. And they're winning big in Africa. Sales have jumped 25% to $122 billion. And this is bigger than the whole of 2020 and on track to hit $200 billion for the first time ever on the African continent. And there are some markets in Africa that are driving this demand. You have Nigeria, South Africa, Egypt. And for a couple of reasons, the yuan is weaker, which is making Chinese exports affordable on the African continent. But there's also growing demand for infrastructure. And we are seeing this demand coming through in goods like construction material, which has jumped 60%. Then you have mobility, passenger cars, trucks, motorcycles. But also very interesting in energy, you have demand for batteries, you have demand for transformers and also solar panels, which have jumped 60%. And this just speaks to how shrewd of businessmen Chinese are. They see an opportunity, they jump on it, but there's also fear of transshipment, where Africa risks becoming China's global trade corridor in a bid to bypass those American tariffs for their goods.
Yeah, though the Americans are certainly keeping a close eye on those transshipments, as in the case of other Asian economies, where there is a penalty applied. Let me just ask you, is all of this interest from China, Chinese exports hitting the African continent, actually welcome?
Jumana, they are welcome, and particularly with open arms, because the relationship between Africa and China has always looked like it's symbiotic and mutually beneficial. If you look at FOCAC, $50 billion that's pledged over a period of 3 years. There are things to show: the Belt and Road Initiative, the SGR. China has not been shy of opening its purse and putting money on the African continent. They're talking about converting US-denominated debt into Chinese debt, and this could benefit countries like Kenya, Angola, Ethiopia that are heavily exposed to Chinese debt. But there's also something to be said about China's efforts to increase trade with Africa. They've scrapped tariffs on some African goods. 19 African countries will be able to export their agricultural goods to China, and this is exposing African goods to the world's largest consumer market. However, there are challenges there. If you look at trade deficit, the value of Chinese exports to the African continent vis-a-vis what Africa is selling there, you can see a huge disparity in terms of numbers and pricing. There's also concerns about Chinese goods coming to the African continent overcrowding, and this could choke local industries. So in summary, you see an opportunity for China to explore new markets, particularly because the American door closed, a new window has opened in Africa, but the continent has to balance between immediate gains and long-term effects.
Yeah. Bloomberg's Aathira Prasad in Kigali, Rwanda, thank you so much. And for more stories like this from the continent, be sure to subscribe to the Next Africa newsletter on the terminal and our website. You can listen to the latest news on our weekly podcast, available on Apple, Spotify, and wherever you get your podcasts. Coming up, we're going to speak about oil prices. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Slower growth. Nvidia delivers a lackluster sales forecast after 2 years of booming AI spend, sending shares lower in aftermarket trading and weighing on markets. Bloomberg learns Mexico plans to raise tariffs on China as part of its 2026 budget proposal next month. That's after months of pressure from President Trump. Plus, oil is falling this morning, despite Peter Navarro stepping up the pressure on India to stop buying Russian crude. Traders focusing on the risk of a supply glut. It's just gone 8:30 a.m. across the Emirates. I'm Aathira Prasad in Dubai. Well, these markets are dipping a little bit. S&P futures down 8 basis points, Nasdaq down 24 basis points. And of course, that is on back of the results that we had from Nvidia. Some weakness in after-hours trade, down about 3%. I would say, though, that going into the event, options markets were pricing in a 6% move either way. So less than what the market had implied, but also suggests a little bit of disappointment. But let's see how this all plays out in the coming days, because there are lots of elements of strength to point to as well in those Nvidia earnings, as we were speaking about earlier on the show. USD also slipping a little bit today. Third day of declines for the greenback. We're down 10 basis points. And then oil also losing some ground this morning, down 0.8%, with Brent trading just shy of $68. With the focus more on the global outlook, the demand outlook, and what could happen with supply and demand dynamics in the coming months. We're going to speak about that in just a few moments with Macquarie. But before we do that, let's just stick with the top story of the day, Nvidia, and take a listen to our guests reacting to the results.
When we have a beat and stocks don't go up, or a hot stock like Nvidia doesn't go up, or it starts to roll over a little bit, that suggests to a trader and a technical analyst that everyone who might own the stock already does. But we're nowhere near there yet.
The reason the stock has recouped some of those losses and I think will retain strength is because of that guide for Q3. It was very strong. It's really all about Q3, and it's because Blackwell and Blackwell Ultra are starting to ship. And if you know that story, you're not selling this stock right now.
They were very good about signaling to the market that the China overhang could continue, and that has about a $5 billion impact in the next quarter's numbers. So having said that, $54 billion represents a very strong showing, which means they expect hyperscalers in other parts of the world to pick up that slack.
All right, that is some of our guests reacting to Nvidia results. Let's check in on the reaction in Asian markets. Yvonne Man is in Hong Kong.
Yeah, Jemana, you mentioned there's some good things to kind of look at in this Nvidia story too, right? The fact that Asia's taking it in stride right now, despite the after-hours trade of Nvidia, that certainly is good news. Maybe there wasn't any huge negative surprises, but the one thing that maybe stood out was them taking out the H20 chip sales to China in that outlook, and really has muddied the outlook for the company. So certainly that's one thing to watch. Asia is slightly to the upside, as I mentioned there. Hang Seng is doing the opposite story here, just given what we saw with Meituan. We'll talk about those earnings in a bit. But that JGB auction, the 2-year, just came out at the top of the hour. It was one of the weakest that we've seen in terms of demand since 2009. This coming at a time when bond traders are really not willing to touch this bond market, given the bets that they want the BOJ, or they are hoping the BOJ will hike rates soon, right? So that 2-year yield is already around those highest levels we've seen since 2008. Korea won also catching a slight bid here today. We had the Bank of Korea holding rates, but they talked about the intervention they've seen of late that actually has been helping to limit the falls of the currency. So yeah, it also helps with that dollar weakness story here as well. Today, you flip the boards and take a look at what is moving. We talk about those chip stocks, right? So all the big sort of tech giants like TSMC and Samsung did react negatively to Nvidia. On the flip side of that, you start to see some of these homegrown chip makers in China continue to rally and really become these market darlings. Just take a look at the Starboard in China onshore, and that continues to be on fire here today. SMIC last trade was up 13%, Cambricon Tech as well. This stock briefly onshore became the priciest stock after Kweichow Moutai, which is quite remarkable as well. And we talked about Meituan, right? They continue to talk about this irrational competition that we're seeing in the food delivery space, and that's really encroaching on the market share that they really have had to dominate of late. But now that it seems to be eroding, right, by the likes of Alibaba, by the likes of JD.com. And by the way, Alibaba reports tomorrow. We're hoping to see, what the results look like there to point to any sort of direction that we're seeing in this Chinese equity rally and whether it can continue.
Yeah, big one to watch out for in earnings, Chinese earnings this week. Yvonne Man in Hong Kong, thank you so much. Let's turn to commodities now. Oil falling as traders look past U.S. efforts to force India to quit buying Russian crude. The White House trade advisor, Peter Navarro, ramped up pressure, repeating accusations New Delhi is funding the Kremlin's campaign in Ukraine.
Everybody in America loses because of what India is doing. The consumers and businesses and everything lose, and workers lose because India's high tariffs cost us jobs and factories and income and higher wages. And then the taxpayers lose because we got to fund Modi's war.
Well, joining us is Marcus Garvey, head of Commodities Strategy at Macquarie. Well, some very pointed comments there coming through from the White House trade advisor, Peter Navarro, likening the war in Ukraine to Modi's war. That's probably a bit of a stretch. I can't imagine that's going to go down well amongst Indian authorities. But let me just ask you, as far as it pertains to oil markets, do you think oil markets are perhaps being too complacent about the real possibility of extra sanctions or extra economic sanctions on Russia, Russian oil, potential disruption to Russian oil on global markets in the coming months?
That's a very good question. I think it's fair to say that there's almost no risk premium in the market. So if you're going to talk about asymmetries around if you were to have a disruption, would that lead to a skew in terms of the price response? There's very little, if any, risk premium in place at the moment. But then I think you can argue that that's actually a reasonably rational position for the market to take in the context of the fact that we obviously haven't lost any Russian barrels from the market to date. And that although, let's say you had a scenario where, for example, you did see a reduction in Indian buying of Russian crude, you then need to assume that that couldn't trade reshuffle to find another buyer, and so that material would be lost from the market. And also that comes in the context that on an underlying basis, in our view, you have a global surplus of around about 2 million barrels a day at present, so that you've got quite a lot of slack in the market for reshuffling to take place. So that actually, yes, very little risk premium, and yes, that creates a little bit of a skew, but I think it's fair that that's where the market is at the moment.
Okay, that 2 million surplus number stands out to me. I think it's on the loftier side of analyst estimates. What does that translate to in terms of where you forecast the price of oil to go by the end of the year?
So our view is that I think as we go into the end of this year and then really looking into next year, you're going to need at some point prices to trade towards levels which would see no growth in terms of US shale supply, and that in our view on, say, a WTI basis, that is prices going into the high or really the mid-50s is what you need to achieve that. And I think that really a key point there that our colleagues in our Houston team have made is if you look at the efficiency gains that have been achieved by the shale producers, that has brought down that break-even point and lowered the sort of numbers you'd need to get into a no-growth scenario for shale production.
Interesting. I'm going to take you on a slightly different tact. I know that you also look at the metals market very closely. What are you thinking on gold here? We had such a massive run-up at the beginning of the year, but things have sort of stalled around these levels. Do you expect that we're going to get another leg up, given some of the recent uncertainty that is emanating once again from the Trump administration, not least as it pertains to Fed independence?
I think if you look at the backdrop for gold, what's been quite notable over the past, let's say, 3 months, is that you've had a series of additional potentially bullish developments for the market, and yet it's remained range bound. It's not been able to break out. And so I think that in itself indicates elements of the rally being a little bit long in the tooth. But the Fed independence point, I think, now is really key in terms of whether we have seen the highs for this year on that brief touch of 3,500, or if you can take another leg up. And so and we'll see obviously really how the legal and the political process plays out. If Governor Cook were to remain in post, then I think you're arguing gold needs to find something additional, or really it's going to stay range bound and probably pull back to the bottom end of that range. If, however, Governor Cook were to leave and you open up the possibility for Trump, so to speak, to have a majority of his appointees amongst the Fed governorship, you then raise some of these questions about what happens with the regional Fed presidents. Then I think the market needs to put a much different risk premium into gold with regards to the outlook really over the longer term for US monetary policy and Fed independence, and that would be an extremely bullish development for the market.
So can gold do well in an environment where stocks continue to make record highs, record high after record high?
I think it depends on what the causation is, in the sense that if you look at gold's correlation with equities over time, the correlation roughly averages about 0 versus the S&P 500. Periods of positive correlation, periods of negative correlation. So it comes down to the causation. Let's say you have a period where stocks continue to rally because you're getting Fed easing, but that actually that Fed easing is potentially excessive in the context of the underlying economic conditions and say the inflation backdrop, and it were to, for example, increase long-run inflation expectations, then you could argue, yes, absolutely, gold can rally in that environment, even if equities are still continuing to perform well.
Yeah. Marcus, Garvey, great to have you with us on the show, head of Commodities Strategy at Macquarie. Thank you. Well, switching over to the region now, tensions are flaring again in the Middle East. Syrian state media says Israel carried out multiple airstrikes on the outskirts of Damascus as efforts to ease tensions between the neighboring countries showed little progress. For more, we're now joined by Bloomberg's Dan Williams. Dan, walk us through exactly what happened overnight and the fact that these airstrikes have occurred on the outskirts of Damascus.
Good morning. Yes, what we have is accounts exclusively from the Syrian side. The Israelis have declined all comment on this, with the exception of an enigmatic ex-post by the defense minister saying that Israel's military is operating in all combat zones around the clock. So what we understand from Syria is there was an Israeli series of airstrikes in a crossroads town called Al-Kiswa, south of Damascus, followed by the bringing in of Israeli ground troops as part of an attempt to wrap up that operation. This may be linked to what has been reported to be eavesdropping devices there that were spotted by Syrian security forces, and the Israelis apparently moved in to intercept their dismantling, their capture, their examination. Again, it's an evolving story, and it's really not clear from the Israeli side what the aim here was, what the goal, and especially as this is rather risky for a front that was fairly quiet since the fall of the Assad regime back in December, a regime that was close to Israel's archenemy, Iran, and efforts by Israel to forge some kind of accommodation with the new government of al-Shara in Syria.
Yeah, but of course we have to speak of the developments in the summer in Suwaida as well, with Israel also getting involved there. And then we know of U.S. brokered talks that took place in Paris last month between Syrian officials and Israeli officials. What did these latest developments, especially the airstrikes in the last 24 hours, mean for progress on those potential new arrangements, quote unquote, between Israel and Syria?
It's hard to believe that this incident will be well regarded by Syria, not least as we're hearing there are a number of Syrian casualties, Syrian soldiers killed and wounded in this Israeli operation. Only yesterday, as it happens, a member of Israel's security cabinet, Miri Regev, said Israel was working to forge a deal with Syria that would achieve long-term stability and security along the border between the countries. It's very hard to know what to make of this operation. Presumably, the Israelis saw it as both high risk and high yield, something very necessary, despite those diplomatic efforts. The question will be how the Shara government will respond to this. And the question is also whether the interest in a diplomatic deal for Israel overrides what it has said is its interest in demilitarizing, as it put it, southern Syria and making sure that the Druze, a Syrian minority with kinsmen within Israel, that the Druze are protected from sectarian violence. So there are a number of interests here jostling against one another. The question is what trumps what and how Damascus will respond to this overnight incident.
Bloomberg's Dan Williams, thank you so much. Well, coming up, we'll be watching out for Egypt's central bank decision later today. It is widely expected to resume its monetary easing cycle. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. We'll be watching out for Egypt's central bank decision later today. It's widely expected to resume its monetary easing cycle after a pause last month. Egypt has been on a mission to tamp down inflation that surged to a record 38% in September of 2023 as it tries to revamp its economy after securing a bailout last year. For more, we're now joined by Aathira Prasad, Macroeconomics Director at Nasser Saidi Associates. Well, that inflation backdrop is key here, because we went from, as high as 38% back in 2023 to the latest figure showing 13.9% in July of 2025. Yes. So does that open the door up to further easing out of the central bank? And if it does, what are you expecting today?
I think so. We're basically looking for a 100 basis point reduction in the rate, which I think largely the market has been expecting that, given the pause that you had unexpectedly the last time. So I think the circumstances are right for the central bank to go ahead with a rate cut. You've had falling inflation anyways. You've had better liquidity in the market, FX liquidity. You've had certain numbers that have come out on the macro side, which are quite promising. Yeah. So all in all, I think there is leeway for the central bank to go ahead and resume its reduction in rates. And we expect this to continue. We are looking for maybe about rates to come down to 20-21% by the end of the year. Of course, that's depending on various factors, including what happens on the global level. If you have a better situation with the Fed, the ECB, everyone going as expected. So,
if the Fed do start resume their own cutting cycle and go for a cut in September, what sort of knock-on effects would that have on Egypt?
Well, Egypt is not pegged to the dollar like the GCC, but still there would be benefits for them. You would be looking at better external financing rates. They have a lot of debt servicing, so that would become lower as well. In general, they would be in a much competitive basis once the Fed starts cutting rates. So it would work to the benefit of Egypt in a bit. So in a way, the Fed cut would be beneficial for the Egyptian economy going forward.
The Egyptian economy has had multiple prongs at play. You've got central bank, but of course you have the reform process. You've had the flexibility of the currency, but all of that goes hand in hand with the fact that Egypt are actually in an IMF program. They received the bailout, in the case of the UAE, some financial assistance or investment.
Yes.
How is the reform momentum right now?
Well, they are taking it slow. It's a gradual approach. So what you've seen is some beneficial efforts in terms of the fiscal reforms, basically on the efficiency of tax collection and so on. And that you're seeing the results as well in the tax revenues hiking up and so on. But there are other parts of the reforms which have been quite slow in terms of the state-owned assets privatization. That's taken its time. It has been very, very slow, because you hear these statements saying that it's going to happen next quarter or by the end of the year, but you don't really see them come through at the rate at which you expect. And I think that's one of the drawbacks that you've seen in terms of where IMF expects the reforms to go, but it has not happened in pace with what they expected.
Would you say that is the biggest risk right now to the Egyptian outlook?
For now, they seem to be doing well. I mean, we have to consider it on what was happening in Egypt a few years back. From that dismal picture, what you're seeing right now is surging tourism revenue. You're seeing manufacturing at record highs if you're looking at the latest print that's come out in industrial production. You've had non-oil exports increasing as well. And in general, there seems to be a level of confidence that exists now that wasn't there before. So in that front, I think Egypt is in a much better place. And the reviews are scheduled to happen again. I think they've combined the next two reviews to happen later this year. And you have the central bank governor staying on to see it through. That's also a positive sign altogether.
Okay, let me broaden it out and ask you about the region as a whole. I can't believe we're already September. It's difficult to believe that we're in September. Yes. How has the region weathered the whole uncertainties around global trade, tariffs? And of course, this region was somewhat spared from the higher levels of reciprocal tariffs, but still not immune to a potential global slowdown.
I think the region has done quite well. They've taken the right steps in terms of, U.S. is a strong partner if you look at the history and everything that's been happening. But they're also keen to open up to the new parts of the world that is emerging. So you have links with China, you have links with India. All of those things are happening in parallel with whatever existing relationship they have with the US and the Western world. And the focus has really been on enhancing their non-oil sector. So if you look at the non-oil growth rates in any of the GCC countries, they are quite strong, and it's becoming a more resilient story of being not just dependent on how oil prices are going to affect your growth, but it's what other sectors can we invest in, and what are the things that we need to put in place so that enough firms come and locate here in order to boost the non-oil sector growth.
So far, it seems to be working.
Yes, absolutely.
Aathira, thank you so much for coming on the show. Aathira Prasad, Nasser Saidi Associates, Macroeconomics Director. Well, coming up, Nvidia slides in late trade as the sales outlook disappoints. More details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Bersachi in Dubai. Well, there's one stock only that everyone's been talking about this week. It is Nvidia. Let's just run through what we got out of the company yesterday. They issued a tepid revenue forecast for the current period, fueling concerns that AI spending is actually slowing. The firm expects sales of about $54 billion in the third quarter, but that excludes data center revenue from China, which missed the most optimistic estimates. I would just say, yes, we are seeing a bit of a negative after-hours reaction in Nvidia stock, but at the same time, they beat on top line, they beat on bottom line. They also said that they hadn't sold one chip to China in the prior quarter. None of those H20 chips have been sold into, and as we know, there has been progress with the U.S. vis-a-vis allowing them to start selling those specific chips into China. So there could be some significant revenue upsides coming through from the Chinese market in coming quarters. That's something to watch out for. And of course, the data center mess is something that other analysts have been watching out too. But this is the focus for Nvidia. How that's translating to broader equity markets, slight dip for S&P, and NASDAQ is also slightly in the red too, as we think about how all this is going to play out in European trade. European markets, however, are up in the green. Keep an eye out on French developments as we think about that confidence vote on September the 8th. And that is it for Horizons Middle East and Africa. I'm Johanna Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.